This is Tom Aspray with the Viper Report Market Wrap video for the week ending August 9th, 2024. Quite a week it has been, certainly, with, in the last 8 days, the biggest down day since October of 22 and the biggest up day since November of 22. Let's look at the charts. The weekly market internal data explains kind of what a crazy week it was. This is one of the sources I have my students rely on regularly to check on the market and to better tune their timing. You can see the weekly totals on the NYSE: 1260 advances, 1638 declines. NASDAQ 1656, 2902. Up to down volume was positive on the NYSE and negative on the NASDAQ. Many more new lows, 767, than new highs on both exchanges. First, let's look at some Trade Navigator charts. Gives you a little different perspective. Important to see that we dropped well below the weekly Stark band on the SPY. That doesn't happen very often. You can see during the April decline here, we came within about 2%, well below it this week, and got down close to the 38.2% retracement support from the October 23 lows. 50% at 487, so we're getting down to the right zone. Below this, you'll see that despite the NYSE numbers, the S&P numbers were slightly positive, as the S&P 500 AD line on a weekly basis was slightly higher, still clearly positive, above its prior peak and its moving average. No surprise that the decline was even more severe in the Qs. We made it down to the 50% support at 422.80, and the longer term uptrend, this line A, also well below the Stark band and getting closer to the lows from the spring. AD line still holding up positive, and that on an intermediate term basis still suggests that the current correction will be a buying opportunity once the selling is over. For the week, it was a mixed bag. NASDAQ was up slightly, S&P basically flat. It's leading now on a year-to-year basis, up 12%, while the transportations are the only ones lower, down 3.6. The Qs are up roughly 10% for the year, quite a haircut to its earlier gains. Big declines in utilities for a change, and in the small caps, they continue to drop. The gyrations were tied in part to the action in the bond market. You can see yields plunged starting a week ago, dropping below the weekly Stark bands, retested the lows, and then closed higher on the week. Looks like this is a rebound, however, in a downturn. We broke the support from early in the year, so yields made a new low for the year, with next major support right around 3.253. Think that is a possible target before year end, after this rebound runs its course. You can see the weekly MACDs are negative, not showing any huge increase in downside momentum such as we saw in late 22 or in late 23, but still negative. If you look at the daily chart of the yield, you can see the short-term low we had, on Monday's and last Friday's trading. Nice rebounds made it right back to about the 20-period EMA, which is, this suggests that yields could rise a bit more early this coming week, but this looks to be a rebound in a downtrend. No signs of a real bottom from the MACDs. Of course, this is all tied in part to the action in the yen dollar market and the carry trade that imploded stock prices starting over a week ago. This is a long-term chart. I'm sure many of you have not realized that there was once 350 yen for the dollar. It got the market excited when it moved above 150. Since the Plaza Accord right on here, I followed the yen on a pretty much a tick-by-tick basis, but we haven't had a so-called contagion day since 2015, right in here when the yuan had a sharp move, and that roiled the stock markets, pushing it down 1,000 points on one day. But unfortunately, it was off my radar, and for that I have regrets. This looks like it probably, is a sign, of a weaker yen over the long term. But the short term outlook, indicates that, the momentum from the reversal last week can continue. Pure charting is lots of fun, which it's what got me excited back when I was a biochemist. This is a real interesting 60-minute chart of the dollar to the yen, showing this move here, break to the downside, clear downtrend here after the upside move to, close to 161. Lots of nice little continuation pattern. Another one here, broke down, another drop from 57 to 51, up to 55, nice little flag. Bam, next target went from 55, to 141, 14-point decline. This one was, a 7-point. And right now, this looks to be another, rally in a downtrend here. We've broken the support here. So if we move much below 144, 145, then, it's going to mean, that, that there might be some additional holdovers from the carry trade, or certainly it's going to likely rile those who are in the yen dollar market and have borrowed any yen as a result. Of course, we have new inflation data this week with the producer price index on Tuesday the 13th and then the CPI on Wednesday. Given the recent jobs numbers, this will be quite interesting. I would expect both to be favorable on the market. Then we get some other manufacturing data on Thursday, which will help us determine whether we should have been worried about the ISM data a week ago. And of course, then the week ends with sentiment data, consumer sentiment, the mid-month reading, and housing starts, as well as the confidence index, which I would think would go up given the move in mortgage rates. So back to the market, weekly New York Composite, you can see it had a nice long tail, so that's a positive sign. Those of you who don't spend a lot of time looking at candles, you can see that, when you get a tail down, here we got it. We got 2 weeks up, back up to the 20-week EMA before we push lower. So this was a sign that there's some good demand down there. That doesn't mean we can't drop back down towards those levels, but suggests that the balance here suggests it will be well supported. Weekly New York AD lines are positive. We had the breakout, slight pullback, because last week on the NYSE, there were more stocks, slightly more stocks lower than higher, and the all, as we showed in that earlier table, was negative but not bad. Well, most of you are aware the VIX shot up to 60 in the pre-market on Monday and have been retreating ever since. Some people, option experts, look at the percentage change in the VIX on a day-to-day basis for buy or sell signals. This would have been a buy signal. To me, I look a little bit more at the pattern. So, right now we've dropped back below the moving averages. This suggests to me that if the S&P does pull back next week, that the VIX and the VXN will rebound slightly and form a second lower high before dropping down back to more sustainable levels in the 20 area. Put call numbers show a similar sign. They peaked, made a secondary pie, so this was the max, put buying in the Monday's open, at 1.6, I guess, in the index. These are important numbers to watch if you're an option buyer. So if you bought puts on Monday morning, I'm sure it's not been a great week. Some of these little subtle things can really save you a lot of money, besides the fact that we're trading below the Stark or the the Keltner channel equivalents, that's always a time to cover shorts, not add to shorts. On a daily basis, the S&P, so we've made it, part way back to this resistance here, about 433. The S1 is at 537.12. 80 lines are positive, but certainly could see another pullback here. You wouldn't want to see a decisive move below the lows of the first week in August here. That would suggest a drop back to longer term support. Based on the daily charts, it doesn't look like the selling is over in the Qs either. You can see we've had a very oversold here down to the S2, rally back to 458, resistance right up in here, going back to the lows from the prior week. AD line, has, a back above its moving average barely, so it could certainly see some more pain. RS shows, no signs of a turn. So QQQs are still weaker than the S&P. This is a chart we've been featuring more frequently. You can see how heavy the selling was on Monday. Another reason to, and this was updated, I think during the day. I may have sent it out on Twitter, to show you that this was down like about 88% of the S&P stocks were declining. That's, once again, another one of those early tells that if you're short, cover them. And if you're really aggressive, you can try the long side. You can see 1500 also was whacked pretty good. Not so much in the Qs. Sharp rally, on last Thursday, and then Friday, very little follow through. 14% of the Qs were higher on Friday, 2% were lower in the 1500, and just 15% with higher. So this is also sort of consistent with a rally that, sure, you get up to the 20-day EMA there, but is likely running out of steam for right now. The recent spike in the number of stocks making new lows is something we can't ignore. You can see it shot up to over 200 in the NYSE, a breakout from the April highs, and the evidence is even more negative on the NASDAQ composite. You can see we had a powerful shot up to like 600. The level we were watching for was, I think, roughly 360 or so in here. So if you look back into a year ago in the summer, you can see what happened. The market was topping out here at the end of July, started to decline. We got a surge in new highs. We got a rebound here, and the new high number of stocks making new lows dropped back sharply. But then, as the market began to decline in September, once again the number of stocks making new lows continued to rise until they peaked at the November lows. So we'll be watching this. If this falls down further, what'll be the key is how much it expands if the market corrects a little bit more. As noted in performance, the rebound in the small caps has been pretty anemic, suggesting that, after this huge reversal, we're likely to chop around for a while. So that's a real interesting development. We would like to see some stronger action in small caps heading into the year end that would support a stronger rally. We are out of this market since hope is nothing to trade or invest based on. Let's take a look at the watch list. A number of sell signals, from the junior gold miners, middle cap, preferred shares, materials, both the Vanguard and the XLB, as well as the pure value ETF and the small cap bull on the TNA. So only one positive, that was Brazil. Interesting development. If you go down into the gauge, 53% are above their quarterly pivot, so that's a negative number. Growth, 22%. Value, 54%, a little bit better. And you can see that XLC was the kind of winner at the end of the month. Despite the pullback, in some of the bank ETFs, they've not given weekly sell signals or drop below their pivots. On the short ETFs, all daily positive for these. Weeklies, a mixed bag. S&P weeklies, are positive, but not necessarily all the Qs. And of course, the long ETFs are all negative. Looking at the growth value, the IWF, that's the iShares 2000 or 1000 growth, it was up 0.4%, and the value Russell 1000 was down 2.4. You can see that the ratio here turned up slightly. So weekly analysis is negative, so you made it down to this support level, so a bounce would not be surprising. To give a boost and suggest that maybe growth is ready to have a better rally, I'll be watching the RS analysis versus things like the XLK, FDN, and also the ratio to see whether it can get back above the 20-week EMA. From the themes report, you can see that the Nasdaq's largest, Meta came to life, gave a weekly buy on Friday. It's about the only bright spot. Tesla is still positive on a weekly basis, as is Apple, pretty much lower across the board. Google could be watched early in the week. It has a 4-hour and a 1-hour, so we'll see if it can generate a daily. That would be a good sign. Dow largest gauge, McDonald's is doing well. Home Depot, United Healthcare was down 5% last week, but looks like if the 3-day doesn't turn negative, it gets back to support, that could be a longer term good opportunity, since healthcare is one of the better performing ETFs. Of course, leading the ETFs are still the utilities, even though they were lower last week. The REITs, the real estate, 91.7, 100% positive. Communication services has gotten a little bit better, 58.3. Verizon had a daily DTS, and I've seen Meta is there as well. So information technology, 8.3%. CRM and Adobe are the only daily buy signals. Financials still surprisingly weak. And healthcare, 83.3. Of course, Lilly was a shining light last week and helped propel the whole center. Indian out, energy 33%, materials 33.3, and industrials 33.3. MP VLO is the only one that looks a little more promising, along with Exxon, which has been holding up extremely well. As for our holdings, Viper Hot Stocks held up surprisingly well through the carnage. We got stopped out of Fluor for took half the Fluor off. Closed out ALC. Pretty much no big hits. Some smaller ones, and Rocket Company's my favorite in the mortgage thing. It's up 22%. On the ETF side, it wasn't a great week. Traders were looking to buy the dip in IWM and QQQ when we were hit pretty good. We had good success trading, particularly the Qs, all year, so this just gave up the last profit. But still, not a pleasant experience. The VEA got a 4% hit. We closed out the second percent of the KBD problem. We took 14% in the first one. Consumer discretionary on the trading side, got small profits, smaller losses on the investor side, and in the VTI in our trading position in SPY. We still have a longer term position in both consumer services and SPY. Obviously, we get up so there's profits. Of course, as always, you go to the Viper report, see some of my latest contributions to Forbes.com, as well as some interesting charts. I'm going to try to put more of those up. And if you're interested, in some one-on-one trading, number of very satisfied students out there, I'll be scheduling for fall classes in September. Hope you have a great week of trading. You might need seat belts for the first part.